Welcome back. Investors keeping their eyes on the stock market as the Fed sees higher interest rates in the near future. But when exactly will investors see a market turnaround? Well, here to discuss that with us is Joe Fahmy, Zor Capital Managing Director. Good to have you with us. So you laid out a number of things that might be needed before the market turns around. So I'm going to start with the first one, which is an improvement in growth stocks. What sort of improvement and what are some of the markers that will really let you know that that's one of the things turning the market around?
Yeah, no, thanks for having me on. We'd really like to see an improvement in growth stocks because that's an area of risk appetite. So the big institutions control the markets. For the most part this year, the things that have done well have been defensive names, some value names. But when they start putting, the big institutions start putting money into growth stocks, that shows that their risk appetite is back on again. So we'd like to see some of the growth and riskier sectors have some money being put to work in them.
And you want the Fed to change its hawkish stance. What's it going to take to do so?
I think they're close to it. I've said since the last time I was on in April that that we wouldn't see any sustained upside until the Fed is done or at least pauses this current rate hiking cycle. I'm expecting them to do it in one of the next two meetings coming up either at the end of July or most likely in September. And I think what will take them to do that is that they don't want to. One reason is they don't want to interfere with the midterm elections, and two is that statistically in midterm election years the market bottoms around August, September, so that would be a good time for at least us to see a end to this downside and maybe a turnaround into the fourth quarter.
And we did see a rally today. Are the markets perhaps too enthusiastic about some of what they're hearing about how much tightening is going to impact the likelihood of a recession?
Yeah, no, the market tends to forecast and trade on what's going to happen 6 to 9 months from now. There are rumors that they're going to do one more hike, maybe 50 to 75, as they mentioned in their Fed minutes yesterday, maybe 50 to 75 more basis points. That would get the market back to the Fed funds rate highs of 2018. So there's rumors that they'll do that, and then they'll pause because let's not forget they've moved a lot this year. And then they might pause and say, let's give the market time for all of these interest rate hikes to filter into the system. So that might be the reason why the market's starting to find a little bit better footing and has been a little bit firmer recently.
How much do you think that CPI number on the 13th will dictate what the Fed does, and what do you expect it to see? Do you think we'll see inflation having peaked or gone up?
No, that's a great question. I think we just want to see the direction. It's still going to come in high, but we just want to see the direction of the data start to slow down. That's why I'm guessing more of September, where the Fed will get at least 2 or 3 more months of not just the inflation data, but the other data that they look at, jobs report and so forth. But I'm expecting it to be below consensus, still high. But if we can get a couple readings that are successively lower, that'll confirm that the Fed will pause at some point soon.
And one of the other factors that you noted about a potential turnaround, a resolution with Russia and Ukraine, obviously the inflation conversation taking the forefront there, but let's not forget where we came from to get to this point as well, on top of COVID. What are you watching for in that space, since we really don't have any sort of information about when a resolution will be actually forthcoming?
Yeah, that would be one of the factors. I think the biggest factor and the main reason, it's tough to put a percentage amount, but the main reason for this decline this year is the Fed raising interest rates, stopping their bond buying, and taking liquidity out of the system. I think that's probably 90% of it. There's also other factors. Of course, we'd like to see some sort of resolution or ceasefire in Russia, Ukraine. But I think the Fed is the biggest factor. And as soon as we get some sort of verbal confirmation from them that they're pausing, I think that's going to be the biggest things for the market.
But I just wanted to follow on that resolution to the Russian invasion of Ukraine. If, in fact, the resolution is Russia annexes part of the Ukraine, might be the eastern section, how much does the economy get back to normal? How much do U.S. businesses return there? How much do we start accepting Russian gas? Or is it still the repercussions are going to be felt for years?
There's still repercussions. And again, I'm not an expert on geopolitics. Of course, that's a factor in all this. And at least some sort of resolution will lower the price of oil and energy. Whether companies go back in there and their businesses go back, that's up to them. But again, it's not really the biggest factor. I'm not trying to downplay that situation. I just think for the U.S. markets, the Fed is the bigger factor here.